Welcome to Kitchen Table Finance, the podcast where we serve up bite-sized pieces of financial advice to simplify your money and your life. Join your hosts, David Shotwell and Nick Nauta, and let's get started.
Hey, Dave, how you doing today?
I'm doing great. How are you, Cole?
Oh, just splendid, just splendid. Anytime I get to fill in for the infamous Nick Nauta is a good day for me.
Well, he, I think, is more than happy to have us do the economic and market talk without him.
Yeah, it's not his favorite subject, but luckily for him, he's got us. So
yeah.
But yes, it is that time of the year again. Going over the previous performance of the last quarter, Q2, and also potentially going to be giving you some insight into what you could be looking forward to in Q3 of 2026. So if you are an existing client of ours, you are very familiar at this point with the glass half full, glass half empty slide that we like to use. And if you are not a client, then a little preview of what you're missing out on. So getting into what we like to do here, we start with the good stuff on the glass half full. We'll do a little bit of our glass half empty to help us stay kind of balanced. But on the good stuff,
balanced point of view.
Yeah, balanced point of view, exactly. But on the glass half full stuff in the previous quarter, stocks were up around the world in Q2 and continue to actually touch all-time highs, which I think if you were to ask a lot of people, it sure didn't feel that way, but that is what the data tells us.
Right. We'll talk about sentiment here in a minute, but I think everything that we track asset-wise was positive for the quarter. International stocks, U.S. stocks, bonds. It was hard to find anything outside of gold and some other things like that weren't positive for the quarter. And we'll take it.
Exactly. What can we say? We're doing good work over here when everything's up. So And on the bond side of things, bonds of pretty much all credit and maturity types also increased in value over the quarter as well. So again, even if you're not overly exposed to the equities market, in theory, your portfolios continue to do pretty well.
Everything looked pretty darn good for April, May, and June.
Exactly. And beyond that, if you are not a retiree, unemployment actually continues to remain near historical lows. And the U.S. economy writ large does continue to grow. So all those are good things for all Americans. On the glass half empty side of things, if you haven't been watching the news, the Iran war continues to progress, for better or for worse. Inflation also has begun to kind of pick up again. Definitely not anywhere near the levels of 2021 that is still, I think, scalded into the memory of a lot of people. But enough so that markets are now expecting that the Fed actually might increase rates by the end of the year as opposed to have a rate cut, which if you were to talk to somebody in January, that was not what we were thinking was going to be happening.
Right. The expectation was we might see 2 rate cuts by the end of the year. And now it's something like a 78% expectation built into the market of a rate increase by the end of the year. So very different scenario there. And that's a little disconcerting for the markets.
Yeah. The other part of our glass half empty is that despite, and we'll talk about this a little bit later in the show, but despite all of the positive market indicators, equities and bonds both showing a lot of growth, U.S. consumer sentiment is actually near all-time lows. I mean, all-time lows.
Crazy. Yeah.
Very,
very big disconnect between how people feel about things right now and what we're actually seeing in the numbers.
Exactly right. And investment markets do continue to be volatile, obviously, around the world. We have been able to reap a lot of the plus side of that volatility, at least over the last 7 months. But that is the nature of volatility, is that it swings both ways.
Right.
Really
does. Volatility can be good, can be bad.
Exactly.
Yes.
So then the other one that we like to do too is we have our Q2 by the numbers. So we take a couple numbers, and then we kind of use that to tell some of the story of what's happened over the last couple of months of the quarter. So Dave did mention 78%. So that is the market implied probability that we're going to get a Fed rate hike by December of 2026. A lot of that obviously came off of the back of the Iran war. And it really
Right.
did shift meaningfully after we have the new Fed chair, Kevin Warsh, who actually in his first meeting, kind of in his first statements as the Fed chair, made it pretty clear that he wants to make sure that keeping inflation under control is actually his top priority.
Yes.
Which is something that I think a lot of people didn't necessarily expect. I think a lot of folks thought that him being kind of the Trump pick, the president wants to see rate cuts, that he would be the guy that was going to get in there and really start stumping for rate cuts. So.
Right. While I don't think anyone really welcomes higher interest rates, at least the vocalization of some independence around that, I think, is at least reassuring that the Fed is going to watch the numbers and do what they feel is right for the economy and not the political side of the spectrum. So
exactly, and that's what you want to see.
Right.
That's always the
Right.
fear, is that if you don't have the independent Fed,
right.
that you'll never meet a politician that doesn't want low interest rates, right?
Right.
And that can lead to adverse economic conditions.
A few years ago, I remember like a pundit on TV. It was the first time I'd ever heard it saying, well, the Fed has decided they're going to be data dependent for the next cycle. It was like, wait a minute, aren't they always data dependent? Shouldn't they always be looking at the numbers at every meeting? So this is nothing new in terms of speculation around the Fed and what they're doing. But
it's like saying Navy football has decided that they're going to run the ball next week.
Right. Shocking.
Is that what they always do?
Well, we hope. Yeah. How about 22.6% for the Russell 2000 during the first half of the year? Seeing small caps have a moment.
Yes. It's actually it's the best first half of a calendar year in multiple decades for U.S. small cap stocks. We over the previous several years have actually seen, really kind of the reemergence of small cap and of international positions.
Yes.
In the years preceding that, it was kind of becoming some nomenclature amongst younger folks like myself that why would you ever not just buy the S&P, because the S&P had done so well for so long.
Right.
But it goes to show that we're moving back toward historical trends where we actually see particularly small cap value really beginning to show superior returns, which of course is something that we tend to lean into here at SRB as well, looking at those historical returns and trying to mold and modify our portfolios to better recognize that. Our third number is 85.7 billion. It's the record-breaking amount of money raised by SpaceX in its IPO in June. The performance has been, shall we say, mixed since it's been public.
It shot out of the gate and then proceeded to fall back to about the levels where it started, which, there's all kinds of historical talk around how IPOs behave, and that's not an unusual scenario. So to me, it's really interesting that that's what everybody's been talking about is these mega cap IPOs, SpaceX being the first. We're expecting, some big AI IPOs before the end of the year. Yet, meanwhile, like behind the scenes, while nobody's watching, your small cap index is up 22.6% year to date.
Exactly.
And
exactly.
That's kind of the way diversification works, and it's the things you're not paying attention to, and the things that you turn around and say, "Oh gosh, boy, that was emerging markets is another one that's just been an ignored topic for so long, and really stellar this year so far."
Yeah. You want the last number, Dave?
This is my favorite, of course. 7.3% is the year to date as of June 30th, return of a portfolio that is 60% all cap world index. So 60% stocks, in a globally diversified portfolio, and 40% in the Bloomberg Global Aggregate Bond Index. So a 60-40 balanced portfolio plus 7.3%, despite all the unnerving headlines, all the weirdness and angst in the world right now, which is there for good reasons. A globally balanced portfolio of stocks and bonds has done phenomenally well again this year so far.
Yep. And, obviously if you extrapolate that out, and it never works this way, and this isn't the right way to think about it, but if you were to double it, that would be a pretty phenomenal
whole year's return.
It would.
On the back of a couple good years return for a 60-40 portfolio.
Exactly.
So yeah, that's encouraging, and that to me, the underlying premise there is that involves no stock picking, no timing, no like how should I shift from 60/40 to 70/30 to just plain vanilla balanced portfolio. Just ignore it and let it work. Yeah,
Yeah. They call that investing versus gambling.
They do. I've heard that. Yeah.
So the next one that we can move to is kind of a review of some of the key economic indicators that we've been seeing, particularly looking at things like core PCE, inflation adjusted GDP growth, and the unemployment rate. So is there anything that's jumping off the page to you there, Dave?
Well, the first thing that jumps off the page to me is that all of these key indicators are fairly good compared to trouble times in the economy. Last reading on core PCE, which is the Fed's gauge for inflation, 3.4%. Inflation adjusted gross domestic product growth, 2.1%. Unemployment rate at 4.2%. I mean, that's the big thing. These numbers are all good numbers for an economy that's clicking along. Inflation is higher than it was a year ago. Unemployment rate virtually unchanged over the year. It was 4.1% a year ago, June, and it's 4.2% now. GDP growth has actually accelerated since last year. So, it sure doesn't feel like a Goldilocks moment, but maybe it is, right?
Could be. Well, and I always like to point out too that, when you're looking at unemployment, the unemployment rate, it is kind of a government statistic, which means that it's not perfect.
Sure.
But B, 4% is generally regarded by economists as being at full employment.
Right.
So obviously there's always going to be some element of unemployment that exists in any economy, but I mean, it's pretty much where you would want it to be. And so people are working.
As a child of the 70s and 80s, I can tell you that 4% is pretty good. Inflation, the Fed's goal is 2% long term. That to me is the one to watch here. And these things all work together, right? They're all cogs in the same machine. If we see a spike in inflation, we'll see, that will affect the other readings at some point. We can't sustain too high inflation for too long. If we see a spike in the unemployment rate, that's going to affect GDP growth, of course.
Exactly. Yeah. Well, and the counter to that too is that, I've always heard you say in some of your meetings that when we're talking about macroeconomic indicators, it tends to act more as a bowl of cooked spaghetti, right? That's the analogy you like to use. And I think that's pretty great. When you're trying to kind of bend the economy to your whims one way or another through policy, sometimes you're pulling on one piece of spaghetti, hoping it's going to affect this piece over here. And it doesn't always do that. So yeah. Well, this, I think, actually is a pretty decent segue into talking about what has really become an increasingly more prominent conversation that's been happening in the world of finance, which is the disconnect between market returns and overall consumer sentiment.
Yeah. Everything's wonderful and no one's happy.
Yeah. That's exactly right.
I should not say everything's wonderful, but the numbers are still pretty good. Let's put it that way. I think that's a more appropriate way to express that. The economic readings are still positive. Things still look good on paper, but very few people feel that way. And
well, and what I was going to say too. So what we're taking this from is the University of Michigan runs kind of the most prominent, well-known, well-respected consumer sentiment survey in the country. And what they're looking at is, I believe, does it go back to the 70s, Dave?
I believe so. 70s or 80s.
70s or 80s.
Longer than you or I have been paying attention. Let's put it that way.
Yeah, exactly. Well, and so the levels that we're currently at are all-time lows. And so when you take that into account, obviously that is COVID. That's 2008.
Financial crisis.
That is, tech bubble. I mean, all of those things, 9/11, everything in there. And so obviously the counter to a lot of those examples are, global pandemic, massive financial crisis, layoffs, unemployment, things like that. Whereas as we kind of went over, inflation is higher than we want it to be, but it's not anywhere near all-time highs. Unemployment is in a pretty strong place. The markets have done exceedingly well, and yet most American consumers don't feel like we're in a good place at all.
Right, right, right. And so there's a couple different things there. One is as a wannabe contrarian investor, at least. Like if everybody, like one of the worst things in the world is to have everybody think everything's great, because then the last dollar goes into the market. Everybody's an optimist. Is there the market needs pessimists in order to keep going up, right? So there's that aspect of it in terms of like how I feel about portfolios, and again, that's just anecdotal, and Dave's feelings really have nothing to do with anything other than
Sure.
uh, just how I'm thinking about this in terms of clients. On the other hand, too, though, it becomes or can become a self-fulfilling prophecy in terms of the economy. If you start seeing everyday Americans say, "I'm scared of where we're headed. I'm afraid of losing my job. I'm afraid of," then the natural inclination then is to hoard cash, right? Not spend
Correct.
money, and do everything you can to protect yourself. If millions and millions of people do that, the growth numbers in the economy will reflect that, and it becomes self-fulfilling. So we need to be
Exactly.
cognizant of how this plays out for sure.
Well, and I think it speaks further to kind of another buzzword that's emerged over the last couple of years, which is the concept of the K-shaped economy, right?
Right.
Where, if you think about this, coming out of COVID, obviously we had upwards of 9% year-over-year inflation in 2021,
Mm-hmm.
while also having, not in 2021, but in 2020 and all of the years since then, we've had really strong market returns. So if you are someone who has an investment portfolio, you've done exceedingly well, and that
Right.
tends to be people that are high income earners and or retirees. And so you have been able to benefit from a lot of market growth, which allows you to spend and to do things that you want to do. Whereas if you're just kind of a wage earner that doesn't really have a portfolio that's living paycheck to paycheck, it's easy to feel like, and you're probably right in a lot of ways, that your wages haven't quite kept up with some of that inflation. And it feels like you're living in two different economies, kind of further expanding upon the haves and have nots
Yes.
conundrum.
Yes. Yeah. And anecdotally, we see that with clients, right? Who um, really do talk about the effects of inflation and what it's meant for buying groceries and buying gas and buying vehicles if they have to. But at the same time, they're invested, and their portfolios, if they're in a 60/40 portfolio, their average return over the last oh, I'm just going to pull up 3 years here. That's, almost a 14% average return on a 60/40 portfolio over the time period we're talking about. And so, like, on the one hand, yeah, inflation stinks. Nobody likes it. On the other hand, if you are of the investor class, which is most of whom we talk to, right, then, like, yes, your groceries may have gone up a couple $100 a month, and that's a real pain in the rear, but your
Mhm.
portfolio's up, 13% every year, since that happened too. And it's so many interesting things to talk about there, because again, we're talking about like not the broad American public, but the people that we deal with. Um, and also just to the psychology of spending, and that people feel that pain at the grocery store checkout line a lot more realistically or viscerally than they do the joy and excitement of opening their investment statement and seeing that they made money last month. Very,
Exactly.
very
Exactly.
interesting. And also, too, just remembering that when you talk about a K-shaped economy, that's really only including one leg of the K, right? And that there's a lot of people that don't have that, um, don't get to reap the rewards of that, or even if they're just working and putting money away. Sure, their 401k balance may be up and they may be worth more on paper, but if you're 40 years old and that money's effectively tied up in an employer retirement plan, it's not doing you any good when you're in line at Whole
Mhm.
Foods, right?
Exactly.
Or the local IGA, or whatever your grocery venue is.
Yeah.
Um,
Your grocer
So
of choice.
yeah, grocer of choice. Yeah.
Yes.
Yeah.
Yes.
If you're
Yeah.
truly in tune to inflation, you are probably not at Whole Foods.
Yeah. 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 Yeah.
so,
Um,
so
yeah.
whole paycheck, as my daughter would
Whole
call it.
paycheck.
Um,
Yeah. Well, it's
so
it's it's
yeah.
funny too talking about that. I think that you know, I think a lot of folks go into performance reviews at the end of the year or what have you, and you're always expecting, some sort of inflation adjustment or some sort of a
Hmm.
raise, and like that's kind of built into you, as well. Like you expect your wages to grow over time. What we
Right.
don't do as good of a job of is having the same expectation for the cost of the things that we've been buying for our entire lives.
Hmm.
And my wife and my mother-in-law and I kind of played this game last night. We were standing in line, and my wife saw some socks on a display, and she's like, $10 for socks. Like, that's ridiculous. And she's like, socks should be $5, which is kind
Right.
of its own fun economic game to play. But like,
Yeah.
we have this idea of, it's almost like when we first started purchasing things, we remember what things cost.
Yeah.
And so we kind of played the game of, my mother-in-law had something. I was like, I remember when I was a kid, you could get a Snickers bar at the gas station for like $1, and now it's like $3.50 for a Snickers bar,
Yeah. And
right?
they're
And
smaller. Yeah.
so, yes, yes. And so ultimately I've decided that I've become back in my day, Coke was a nickel sort of person.
Right.
But
Right.
but yeah, it's,
Right.
it's it's a fun little thought
Well,
process to go through.
so, and in bringing it full circle, your comment about your wife and socks should be, the price of socks should be what the market will bear, right? I mean,
Exactly.
we're both microeconomists in some form at heart, right? So if people are willing to pay $10 a pair, then that's the right price for socks. And your wife's only willing to spend five, I guess no socks for you.
Yep.
But really, that kind of gets at the problem, the distorting problem of the K-shaped economy that you're talking about. There's some people that are like, I don't care. I'm going to go to Whole Foods and I'm going to pay $6 a pound for Honeycrisp apples, where there's someone else who is very sensitive to those prices, and they're at the local IGA. Their apples are more expensive because there's other people at other grocery stores that are willing to pay more, and they don't have the liquidity, the income, the ability to ignore it the way people on the upper rung of the K-shaped economy do. There's no good answer for this, and I don't want to sound like there is, but I think it does get to that heart of why people are so sensitive to inflation and why consumer sentiment is so low when the economy itself isn't showing that.
Yeah. 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 That's very fair. Well, going from there, I do think it's fun to take a peek at some of our global returns, just as we like to do from quarter to quarter from time to time here. So looking at specifically, I did want to look at, if I can pull it up here, the year to date, or excuse me, that's the 1 year, and kind of further talking about some of the returns that we've been seeing.
Yeah.
I mean, some of these numbers are crazy. So
Mm-hmm.
U.S. small value, looking at specifically just the U.S. returns when it comes to stocks, the U.S. small value is up 43% over the last 12 months. Small growth is up 38.7%. Large value is lagging, but still, I mean, listen, if this is lagging, I'll take it. Large,
27.1.
yeah, large value is 27.1%. The total U.S. stock market's up almost 23%, and large growth is up 17.7.
Yeah.
So,
Yeah.
I mean, and obviously this is fantastic, but this is the price that you pay to ride the roller coaster, right? I mean, this
Mm-hmm.
is the thing that, when you do have those years where it's a bit of a bloodbath. I mean, the reason why you hold is for these
Mm-hmm.
types of returns. And I have not yet been an advisor during something equating to a bloodbath at this level, and I think that a lot of people haven't. But give me a little bit of advice from a guy that was doing this in 2008.
Well, yeah, that's difficult because the first thing I'll say is this. All like logic and rationale, at least when you talk to clients about like market history, goes out the window. It's all about like how it feels right now and doing your best to overcome the emotional effects of, oh my gosh, what if this continues forever? Because
Sure,
rationally, like we're really good at advisors of making the rational case, right?
sure.
but but at the end of the day, what people need to be able to deal with is the emotional side of it, which is going to feel like, and there's all kinds of behavioral finance analogies, but at the bottom line is we've been programmed for, running away from things that hurt and running away from
Yeah.
things that are dangerous and painful. And that's the wrong reaction in the markets. And so, we just, I personally feel like just being aware of that is half the battle, right? And just being able to say, nope, I can't give into this feeling. From the advisor side of it, I'll tell you the toughest thing in 2008, 2009 was keeping your own religion after having the same conversation with the same people for 18 months of, it'll come back.
It's going to get better.
Back.
Just hang on.
But I said that 6 months ago and it's just gotten worse.
Yeah.
At some point I'll be right. But you do start to you have to be careful of not, eroding your own belief in what's going on, because just when that happens is going to be the time when the switch flips.
Yeah.
And,
yeah. Well, it makes me think about, I forget which of his books it was in, but Morgan Housel talks about, when we're in pain, obviously, our animalistic response is to, try to not be in pain. And the example he gave was a fever. So obviously a fever is not a fun feeling. We've all experienced that. And there's a strong urge to take, acetaminophen and to make that fever go away. But the fever is actually there to help you. It's ultimately there to make you better. And so the example that he gave was talking about how, often enough when you see significant downturns in the market, it's kind of a cleansing mechanism, really. A lot of it is in a way, it's a bit of a purge.
You got to get the weaklings out of the market.
Yeah, exactly.
I mean, I've heard it put that bluntly by the like a you have to have capitulation to get back into an upswing. By capitulation, it means everybody that's going to give up and sell has to do it.
Yep.
Yeah.
Yep.
Yeah.
You got to cry, uncle.
Yeah.
Yeah. Well, and just to round it out too, we have. We place a larger emphasis maybe than some U.S. advisors on making sure that we are globally diversified as well. Part of that has to do with what's known as the home country bias, which is if you're an investor anywhere in the world, you tend to place a larger emphasis and a larger weight on equities that exist within your country or your locality, which is kind of a bit of a logical fallacy in its own right. But, to just highlight that we were right. Emerging markets have done exceedingly well. You mentioned that earlier, up almost 44% over the last 12 months, which is nuts. International developed large values up almost 30%. International developed stock market in general is up 21%. So, that's, again, speaking to the reason why we want to make sure that we are not just super duper heavy into the U.S. markets as well. And it's been paying dividends, which has been great because, as you've been telling me for the last couple of years I've been here, it's been more of a justifying to people why they should own an international versus, why they shouldn't. So.
Right. Yeah. It's been a lot easier conversation than it used to be. So, yeah.
Perfect. Well, unless you got anything else that you think we should be covering, Dave, I think that more or less is what we have for folks today.
No, I don't have anything else to add except that we'll have the full analysis of the last quarter and the outlook that we've been discussing here. We'll have that available on our blog and in the show notes here in the next day or two.
Awesome. Perfect. Well, as usual, thank you everybody for listening. If you are interested in learning more or finding out how you can work with an advisor here at SRB, you can email us at info@srbadvisors.com and or check out another podcast episode or show if you're on a long car ride feeling bored or just like the soothing sound of Mr. Shotwell's voice.
Thank you, Cole.
Absolutely. Well, I'll see you next time, Dave.
Have a good day.
Thank you for joining us for another chat about your retirement and finances. Please hit that subscribe button. You can also contact us at srbadvisors.com or email us at info@srbadvisors.com. See you next time on Kitchen Table Finance.